Now, don't be mistaken. Paytm is not the story that we want to focus on. What we want to focus on is the approach to investing in IPOs. My guest is Vivek Bajaj, the co-founder of StockEdge and eLearn Markets. Thanks so much, Vivek, for joining in. And you've listened to what I've said so far. You've listened to that one analyst that talked about the valuations of Paytm. But like I said, that's not the story. What I want to focus on is the approach to IPOs. Would you say it's correct that investors, retail investors, have gotten too used to listing gains and therefore have been spoilt by that, and the approach needs to be very closely examined?
Thanks, Alex, for inviting me. I'd say, there's nothing right and wrong, because today we'll get an opinion from an analyst who will question this. Tomorrow, if Paytm goes up by 20%, you'll see many opinions coming where people will say that, oh, we missed it, we should have done this. So there's nothing right and wrong, because frankly speaking, it's quite open-ended right now, because this new gen business, the new way of doing business has kindly opened mind for a lot of people. And I'm not in favor of anyone or against anyone. What I'm saying that it's high time investors should know who they are, because these issues will come, which will look like expensive. And then there will be issues like Nika, which will still be expensive, but you still make money in those IPOs because there is more road clarity in the path. Paytm obviously has more ambiguity in the path. That's why people are questioning it. So an investor has to understand what they are, and they have to focus on very simple concept, which Warren Buffett have explained us over and over again and again, which is the circle of competence. So if you are not able to understand these business models, stay away. If you can understand simple business model, there are enough opportunities in India, IPO or post-IPO stage, where you can still make a lot of money in coming 5 years. So why to venture out in something which you don't understand?
I want to focus on the IPO process. The thing is that I think a lot of people, and you hear this in anecdotal conversations, you hear this in your friend circle, right, Vivek, is that you subscribe to the IPO, acha, you've gotten an allotment, oh, very good, on the listing day you've made significant gains, it's gained by 50%, 60%. Should that really be the approach when you're choosing a company? That, okay, you know what, the retail subscription is really, really high, I should try and get an allocation? Or do you need to understand the company itself before you choose to invest in an IPO?
Well, if retail percentage was a benchmark, then people would not have invested in Paytm, because the retail subscription was not as high as other new gen business IPOs have seen. Obviously, business model and understanding of the business, and not just hearing the neighbor who has probably made a lot of money in some IPO a few days or months ago, that cannot be the benchmark. But the term to be used is FOMO. And today's market is giving all of us, everyone, not just retail, but even people like us who have been in market for so many years, this market is giving enough FOMO for all of us to commit mistakes. So the process definitely is not the one which has been followed right now, that look at the percentage of oversubscription by QIP or the retail and take a call according to that. And the concept of gray market, which has now become so open-ended that it's no more gray. Everyone has started talking about it because people have access to those gray market premiums. So all in all, there's so much of information available that people are getting lured more towards information which are technically noise. The old school standard thought process of evaluating a business and making sure that you understand those businesses before you subscribe to an IPO, that is taking a backstage. I think now it's more noise and liquidity which is driving the decision making. So yes, accidents will happen because that's not the right path to follow.
Incidentally, speaking of FOMO, our managing editor actually coined another term. I don't know if it's his, but he pointed it out today, Vivek, which is that you can have the joy of missing out. If you missed out on an IPO that crashed about 28% on listing day. But that's something to look forward to. I guess if you follow a few principles, it'll hold you in good stead, right? So if I were to ask you, Vivek Bajaj, how do you approach, on an individual basis, choosing whether to subscribe for an IPO or not? And I'm actually hoping that you'll give a few pointers that will not require my viewers to study the balance sheet and the cash flow statement and all of that. It can be a little simpler than that. Of course, you can list those things out for those who are capable of following those points.
I would always suggest that making a thematic understanding of a business is very, very critical. And that can only happen once you get into the business, understanding of the business. And all these IPO document, which is filed by SEBI, to SEBI, they have fairly decent literature on the sector, the theme behind this IPO, the purpose of the IPO, and what exactly the company is looking forward to do with the money they have raised. If you see specifically Paytm, a lot of money was used to kind of give exit to the existing investor. Now, those are all red flags, which you should question yourself, that why is company not using significant chunk of money in doing its follow-on growth perspective expenditures? So, I mean, the top of the funnel understanding of the IPO rather than getting into the deep financials, because financials is always subjective, and we all know that the whole concept of valuation is evolving. Now PE is no more relevant, at least in today's time, when people are saying that let's focus 10 years, 15 years, 20 years revenue projections of a company. So as a layman, how do you do that? It's practically not possible. I think understanding of the theme and why the money has been raised for what business, and getting convinced with that business model is the primary thing one can do. Otherwise, it's very difficult right now to take a wise call. Secondly, I would say that you don't know exactly which IPO will do good or which IPO will not do good, because there are so many people who are guiding us for an IPO. So I would say a fixed allocation at this juncture, because we are in a bull market and you will get a lot of IPOs who will give you good return. For example, Sigachi Industry, which came out with an IPO, the price is almost 250% of its IPO price. So you will get a lot of IPOs, and maybe you will not be able to comprehend those businesses. So the second thing is have a fixed allocation for an IPO across the board, and some IPOs will do good, some IPOs will do bad. So end of the day, in this bull run, you will still make money, and because the IPOs overall will do good in the market.
That's a great approach. And speaking to your point of understanding the business model, it does not take a business graduate or a postgraduate to understand what Warren Buffett called the moat, right? You're trying to understand whether or not a company stands out or has the potential to stand out in its chosen field. Is that the core of trying to understand whether or not you want to put your money in a particular company, whether you want to own a slice of that company?
So, India is a land of entrepreneurs. All of us by heart are entrepreneurs, and we don't really need to be a rocket scientist to try to gauge the relevance of a business, right? So yes, those are the factors which you mentioned, the moat and other things which gives an edge to the company. But first thing first to be answered is how is the company making money, and whether that money making thing is possible in future. The new gen companies have a very different way of looking at things. I was hearing Ramdev Agrawal's interview where he said that they invested in Zomato because of XYZ reason. And, it's very difficult for a traditional profitable oriented business model investing to look at the new gen investing, because typically the new gen investing, you will always see loss in the profit and loss account because they don't capitalize in the balance sheet. So the balance sheet item is part of the profit and loss. So you think there are losses, but those are all capex, be it marketing expenditure or team expenditure. Those are all capex, which for a layman, it's very difficult to comprehend. So I would say that there is a very different framework to evaluate new gen businesses. And it's not going to be very easy for a layman to understand that framework. So I will never, refute any new gen business, because this is a new world we are living in, especially post-COVID. The tech-enabled new gen businesses will do phenomenally well in coming 10 years. But which one will become an outlier, we don't know. So I will definitely have some capital allocated in my wealth, which will be a risky capital, to allocate for new gen businesses, because it's very difficult to say that which one will do phenomenally well.
Understood. It's been an engaging conversation, Vivek, and hopefully our viewers have taken something from it and will benefit from this. And I hope to hear from all of you who've tuned in. Let us know what you think in the comment section on any of the videos on social media, or in fact, you can write to us on any one of those social media platforms. Thank you so much, Vivek, for joining in and for having that conversation with us.
Thank you.